Hi, everybody. Welcome to Friends Talk Money. I'm Pam Kruger, co-host of Money Track on public television and founder of wealthramp.com.
I'm Richard Eisenberg, a personal finance writer and editor, and formerly the editor of the Money and Work channels for the PBS site for people over 50, nextavenue.org.
And I'm Terry Savage, nationally syndicated personal finance columnist and the author of The Savage Truth on Money.
We're three friends who like to talk money and all the issues that come with it.
On this podcast, we're trying to help you understand your personal finances
to get you and your retirement on the right path for true financial peace of mind. Hi, everybody. Today we're talking about a topic that may seem old, and yet it will always be new again. We're talking about investment schemes or frauds. So no matter how much we think we've learned lessons, these mega scams never really go away. Most recently, you probably heard about how one of the biggest cryptocurrency exchanges, FTX, was really just a giant $10 billion Ponzi scheme. These things keep coming up. A Ponzi is a fraud where there's really never any actual investing going on. Instead, the early investors get paid from the money that's collected by the scam artists as the new investors come in. So they're just getting paid back their own money. Now, the biggest Ponzi scheme in history was the Bernie Madoff story. And in case you haven't seen it yet, just in January, Netflix released a documentary called Madoff, The Monster of Wall Street. Over 4 episodes, the producers retell the story of how this one man, Bernie Madoff, used his personal and professional stature on Wall Street to swindle $64 billion out of investors and fool regulators in the process. And some of those who were scammed were unsophisticated individuals, people who invested their life savings and just had a lot of money to invest. But a lot of his investors were also sophisticated, educated, professional investors, and pension fund caretakers who should have known better. Madoff's described as a financial serial killer. And just like any other good murder mystery, I decided I wanted to watch the Netflix series for the drama of it. I was all ready with my popcorn, ready to go. I didn't really expect to learn too much because 15 years ago, the Madoff story was on the front page of every newspaper, every news site. I was devouring every detail. But I was surprised because actually there's a lot to learn by watching this account. And my co-hosts, Terry and Richard, agreed with me that these are lessons that are worth sharing on our podcast today. So each of us are going to share our own new lessons from this old story. First, though, let me ask you guys, you watched it. Richard, Terry, what did you think of the documentary overall?
Terry, do you want to start?
Yeah, I thought it was nauseating. I mean, it was well done. But the story was nauseating. And frankly, if we weren't going to do this podcast, so we had to watch all 4 parts, I would not have watched the last 2 or 3 parts. It was sad. I lived on Wall Street contemporaneously with this happening. And I don't know that everybody out there realizes, before all this, Bernie Madoff was a legendary figure on the street. He helped digitize Wall Street. He helped enable technology on Wall Street. He was the head of the NASDAQ. He was on every SEC committee. You'll see some of that in the story. But he was a legendary character, and he had a trading firm. He had a big business trading, making markets, and that everybody knew about. What the story reveals that on a separate floor in the same building, he had a side business that's the basis of this Ponzi scheme, where he purported for a few close friends at first, and then more close friends, and friends who he would, quote, allow into this thing. He had a couldn't lose investment scheme, and he kept attracting more and more money. And that's where the fraud was. But on the outside, there was the family, his sons were involved in it. I firmly believe then and now that they didn't know what's going on. They were the ones that turned him in. And it's a tragedy of Shakespearean proportions for him, for his family and for all the people. By the way, people have gotten almost 85% of their money back. That's another aspect of it, but because of the trustee. But it's still a lesson in too good to be true. So I went on. I hated it, and I just know that we have to talk about it.
Yeah, well, I agree with everything you said, Terry. I would say I wasn't sure I wanted to watch this series because I felt like I'd read a lot about Bernie Madoff. I've seen other documentaries. I felt like,
Yeah.
well, what was I going to hear that I didn't know before? And yet, after watching it, I would really recommend people watch it because it's very different than the other documentaries that I've seen and even the other articles that I've read, for two reasons. One, it really does a great job of going to detail explaining how Madoff pulled it off. How could he do this Ponzi scheme? You know, I felt like I kind of had a rough idea. Here he actually shows you these were the steps they went through to fool people. And there's some great interviews by the filmmaker, who, by the way, usually does crime films, and this is a financial crime film. But he interviewed journalists like Aaron Arvidlund and Diana Henriques from the New York Times, who are experts on Madoff. They've written about it. Diana wrote a book about it. Those were really great interviews. And also there's a terrific and sad interview with a couple who were investors who were taken in by Madoff and didn't know what they were getting themselves into. I also felt the documentary did a really good job explaining how it is that the regulators missed it. It seems like that shouldn't have been possible. The SEC should have been able to find this out. And in fact, as some of our audience knows, the whistleblower Harry Markopolos went to the SEC not once, not twice, but three times to warn them about Madoff, and the SEC didn't do anything about it. And he's interviewed in this series, and you hear what he told them and why nothing happened. The other thing that really blew me away was how many investors were involved. I guess I thought it was kind of a small number of very, very rich people. It turns out there were about 5,000 investors around the country that were investing. And as Pam said, some were small, some were big, some sophisticated, some unsophisticated. There were a lot of people.
And it was all around the world. I mean, there were more investors internationally than there were in the United States. And it was just, it's just something that, this is why I wanted to dig in and remind everybody that this classic Ponzi scheme that went on for decades and just kept going on. And the only time these things really stop, and the only way these people get caught, is when something happens that the game is up, the gig is up. And for Madoff, the game of musical chairs came to an abrupt end. The music stopped right during the credit meltdown and the financial crisis, right when that hit. And then new money, it wasn't because the regulators, saw the light. It was because the new money that he needed to feed in to keep this Ponzi going kind of slowed down and stopped. And of course, it was, what you just pointed out, Richard, with Harry Markopolos, a forensic accountant who's just sitting on the sidelines there screaming at the top of his lungs, fire, fire, fire. This is a scam, folks. And, obviously, $64 billion later is when this whole thing came to an abrupt halt. But Terry, let me ask you, from watching this docuseries, what were your biggest takeaways that you think that people can really benefit from, and anything that we missed the first time around with this story? Red flags.
Okay, but now look, you talked about Harry Markopolos, Richard, the accountant. 5 years before, he put a well-reasoned argument on paper, and you see it in this series, and brought it to the SEC and said, based on the financial, the market, this could not possibly be true. This is a massive fraud 5 years earlier. So the first tip-off, and it didn't have to be in hindsight, the man never reported any losses. So he had 2 months out of like 7 or 8 years where he had a slightly down 1 or 2% month. It is absolutely impossible. I've lived in the markets all my life. Nobody is right all the time. That was the outright thing. Too good to be true. It's not true. The other things were everybody, the investors they talked about, they felt special and privileged to get into this deal. You had to know him. You had to be at the country club. You had to this or that or the other thing. It was a privilege. And you had to keep it quiet. You couldn't talk about it. if you didn't want to be kicked out. And if you had asked questions, it shows during the program, if you ask questions, he'd turn around and say, look, you don't like what I'm doing, you don't like the returns, take your money. And he counted on them. Now, he had a few big supporters from the beginning who were obviously complicit, who whenever there would be a short withdrawal period or people would start to take money out, he'd call them and say, we need money into this, I need money into here. And they'd put money in. It's how it maintained for so many years. But the red flags are the immediacy, the keep it private, the trust me, and the there are no losses. Folks, if it sounds too good to be true, it's clearly not true. And I would say one other thing. That wasn't a one-off. Throughout, I mean, Ponzi was a swindler from 100 years ago, and that's how this kind of idea got its name. The new money pays off the old money, and in the meantime, they siphon off money for what? He siphoned off money for not only his yacht and his country houses and his Palm Beach house, but to keep his other trading business, which wasn't doing so well, afloat. Okay, so he could still be Madoff king of Wall Street. So that's where the money went, and it went down the drain in his really public, well-known trading business. These things happen with regularity. I mean, Sam Bankman-Fried, how did he get away with it? He handed out money like it was, lettuce leaves to congressmen and senators.
Smart people.
Smart people. So the other lesson is trust your gut instincts. The smart money is not always so smart.
Well, I want to echo what Terry said about if something seems too good to be true, it probably is too good to be true. You just cannot expect, it is not possible to earn 9% a year every single year, no matter what happens in the stock markets. And that was really the red flag, I think, that the investors should have noticed. Even if they didn't know how it was being done, they should have said, this doesn't seem possible. The stock market's gone up one year and down another year, and yet I'm always earning the same amount, and I'm earning money when nobody else is earning money. That just doesn't seem right to me. And so I think that should have been a red flag to people, and it should have been a lesson for people. The other thing is, another big lesson to me is you can't trust other people to be looking out for your money. It's up to you to look out for yourself. And I think a lot of people just assume that, well, everything's fine, and my advisor told me about it, or a friend told me about it, so I don't need to worry about it. And by the way, Bernie Madoff had a very well known reputation on Wall Street and in finance as being, a big deal and a good guy. And he had, he chaired committees and that sort of thing. So people heard his name. And I guess what I'm telling people about that is, just because you hear somebody is supposed to be great doesn't necessarily mean that they really are great. And I guess the other red flag I would mention is that, as Terry mentioned, the company was very secretive. They would not want to reveal anything when people ask questions. And if you're dealing with it's your money. If you're dealing with a company and they won't explain to you some question you've got about how it happened or the details of the transaction, that's a reason to, I'd say, walk away, move on, find somebody else, because we all deserve better than that.
Yeah, it's less about lessons in finance, and it's much more about lessons in just follow the leader psychology. Because you know what? We do this on a regular basis in our own lives with investment advisors. If I had $1 for every person who said, oh, I got the name of the advisor from a friend of mine. Well, why? Because you assume that your friend, who probably knows no more than you know, did all of the due diligence for you, and that you don't have to do any of it yourself, right? I'm going to tell you the 3 things that really made me think a lot after seeing the way that they really separated out in this docuseries that Madoff was running these 2 businesses, the trading business, and then he was running an investment advisory business that was unregistered. This is what's so important. Now, this was unregistered, meaning his business as an investment advisor. And remember, Bernie Madoff was basically operating as an investment advisor. So legally, in order to advise clients as a business and get paid for that advice, any investment advisor is supposed to be registered with the SEC or the state if they're smaller. But I'm telling you this because in the real world, if you or I are hiring an investment or a wealth advisor, a financial advisor to manage our individual portfolios, the first thing that you would do as a consumer, as an individual investor, is to look up that advisor's name and make sure they are, in fact, under the in the database with the regulatory authorities, because this is where you learn what's real and what isn't real. Now, Bernie Madoff went out of his way to operate in a rogue way, and he completely operated off the grid, but as an investment advisor. But he never bothered to register, and the SEC never required it.
That's critical. The SEC twice investigated him. They sent lower level investigators in. And they said, tell us about your investment advisory business. And he said, I'm not in the investment advisory business.
Right.
They never saw the 17th floor or whatever the floor was. They saw that we're in the trading business. We hold securities. He out lied, and because he was Bernie Madoff, he got away with that. But you're right. You just go to FINRA.org, broker check at FINRA. You can get any market registrant's history.
It's literally like the surgeon performing a heart transplant and not even being a doctor. These victims they skipped over the logic of just even checking to see if he was. I'm not saying that would have stopped him from people from making the mistake, but I'm trying to tell you this in the real world now, not because Bernie Madoff, you have to worry about him. He's gone. But the next one's not gone. And guess what? The next one's not as big as Bernie Madoff. You're not going to see him coming. So the only way you're going to see them coming is you've got to go make sure that they are either licensed or registered. They have to be in the regulator's database. And I'll have links to that in the show notes of how to do that. I don't care if Elton John's invested in something. Any advisor who wants to manage your money has to be authenticated, because no real investment advisor is going to want you to get your money unless they're operating that way, unless they're rogue, unless they've got a bad intention. So you always keep your funds. By the way, this is another important point. This just went over everybody's heads. We're going to write the check to Bernie Madoff. He wasn't a hedge fund. He wasn't a mutual fund. He wasn't even an investment advisor. But in a real world, again, in the real world today, forget Bernie Madoff for a minute. You're not going to write a check and give it to the investment advisor as though they're going to have your money. The money's going to go to Schwab. The money's going to go to a custodian. It's going to be held with a Vanguard. Wherever the money is held, the advisor gets paid to advise. That's the difference. You can ask them to help you execute your portfolio, but the money, that way you have two separate sets of statements. You don't just get one set of statements from only the investment advisor who has your money, quote unquote. But let's talk about the elephant in the room for a second. We talked about the regulators, and the unfortunate reality is, and they know this, the regulators in this case inadvertently wound up protecting Bernie's scam and keeping it going, because if they had bothered to follow their own rules and require that Madoff, register as an investment advisory firm, there would have been, paperwork and a lot of information that he would have had to have turned over that you and I would have been able to even see just in the public records. And probably that would have ended a lot sooner. But I say this because, now we know that, that happened, and it really was the regulator's failure. Now, my last insight here that I'll share with you, with help from an attorney. His name is Phil Adikoff, and his job is to help people who have already lost money due to scams, much smaller scams, swindles, big ones, small ones. They happen all around us every single day. It might be bad brokers. It might be rogue investment advisors, or it might be Ponzi schemes. But I asked Phil the important question here. What have industry regulators put into place to prevent the next big Madoff scandal? Here's Phil.
Well, it's not realistic to think that anything the SEC or any other regulator does is going to prevent Ponzi schemes. And that's because the folks who put these Ponzi schemes together are well aware of the regulations, what changes have been made, and continually change the way they pitch these things to avoid an outright referral in terms of something going to the regulators. So it's not very helpful.
But that doesn't mean that the SEC and other regulators are not protecting us in the public markets. They are. They do it every day of the week for regulated investments. It's the regulators who keep the markets running in a fair in an orderly and efficient fashion. Terry, Richard, we're talking about unregistered, we're talking about completely rogue transactions and private deals. And the problem is people get scammed when they put their life savings into deals that don't fall within the existing regulations. These are what I call off-road investments. It's the private transfer of capital, and it's what you often get for these kinds of investments that are not regulated is a promise. And the promise may not even be worth the paper that it's printed on. So again, there's a big difference between unregulated private deals and, you know, the regulators who are watching over public markets and advisors who are registered. So who is protecting those investors? Well, you are absolutely on your own to investigate any private offering before you invest. And the most important thing to remember here from this story, because it's going to happen again and again and again, is that you can't get scammed in this type of an investment unless you allow it. And that's the important point here from all of these. How do you stop these Ponzi's? Very simple. Stop investing in them.
Yeah, well, Pam, I think that's pretty optimistic. Let me say a couple of things. There's probably a bunch of them going on right now. First of all, the regulators that you think are regulating things may not be. You know, we right now, there's a big fight in Washington over who regulates crypto. Some crypto transactions are what we call cash and through an alternate banking system. We have registered futures on Ethereum and Bitcoin. So those are registered, but those are registered with the Commodity Futures Trading Commission, and are cryptocurrencies themselves commodities, or are they securities? That hasn't been decided, and there are a lot of big cracks. So I'm sure that you all are getting exposed in some way or another to the attractions of markets that are either not clearly regulated or the regulations haven't been defined. Second of all, a lot of these scams rely on, as you pointed out, Pam, somebody famous. I mean, what did Tom Brady and Gisele Bundchen know about cryptocurrencies? There was one for commercial bridge loans a few years ago where a well-known investment advisor fronted that deal. And I never know how that came out, but I warned against it. It was very disappointing. There's always a product where your money is not held safely, where it's not really that, but it's really a good deal. And there always will be things like that. So it's not about the regulations, because it's not about the verbiage. It's about that inner good sense you have to avoid something that looks too good to be true. It's just not worth it. And sadly enough, it's an old savage truth. The lessons that cost the most teach the most. And in this case, they were very costly lessons. They always are.
Yeah.
So let me just follow up on that. As far as cryptocurrency goes, so the SEC did fairly recently file a big complaint against Sam Bankman-Fried for what they call massive years-long fraud in cryptocurrency. And I'm glad that they did that, and I'm glad he was arrested, but it was very much after the fact. And there are a lot of people, including some on Capitol Hill, who feel like, once again, the SEC was asleep at the wheel, that how did they let this happen and now go after him, you know, long time after, when people were actually affected by it and having their money in it. So, you know, I do feel like in some ways we're seeing a return to what happened before with Bernie Madoff. I also took a look to see, well, what has the SEC done differently since Madoff to change the way they are protecting investors? And they have done a few things that I think are good. They restructured the enforcement division. They have a centralized system now to track, analyze, and report on tips and complaints. They didn't have that before. They created what they called the Office of Market Intelligence to gather all these tips. And they've got some new rules. But here's the one thing that I'm not happy about. They've got new custody rules. And Pam, I'd love to hear your thoughts on this. They require registered investment advisors who control or have custody over their clients' assets to hire an independent public accountant to conduct an annual surprise exam, which is great, but the rules only encourage registered investment advisors to place their clients' assets in the custody of an independent firm. Now, why aren't they requiring that? That's the part I don't understand. when you encourage them, I don't think we can expect that to happen
Of course.
all the time or when we need it to happen.
Of course, this is why vetting advisors is so important, because the advisors who are in the network that I recommend and refer, none of them would hold the client's assets. They don't want to. They don't do that. These are all things that are allowed to happen, and it's buyer beware. And it's really important that if registered investment advisors, are regulated, which they are, that that's something that should be black and white. I agree with you. I don't think that should be a sort of a gray area of just encouraging. Anything can happen. If somebody's intentions are bad, somebody's intentions are bad. The other thing too is that what I want to walk away with from watching these series and then sharing it back with you is just, I'm not trying to scare you, and I'm not trying to say, oh, you should only invest in plain vanilla stock market and all of that, and you should never look at investing in a startup or a private equity deal or something like that. But I'm just trying to say, you've got to look at that like it's a speculation, and use your sandbox money, not your life savings. You just don't want to do that. And then as far as advisors go, again, you've got to be able to find them in the regulators database, because they are regulated investment advisors. And anyone who falls outside of that and you do not see their name and you can't find their name in the regulators databases, just completely forget it. Walk away from it, because there's a reason that advisor doesn't want to comply. They don't want to be registered. Bernie Madoff didn't want to be registered, and there was a reason for that. Anybody else have any final thoughts?
Watch it. Just, you know what? It's not entertaining because it's painful. This is painful for everybody involved. It should be embarrassing for regulators, for sure. Painful for all the people that were scammed and victimized. And I hope it's a lesson, because I think, Pam, you started out by saying and Richard, you for sure did, nobody's watching out for you. This is your money. Nobody cares about it as much as you do. And I leave you with my last rule that's guided me through all my investing life and everything else for that matter. When in doubt, don't. Just don't.
Yeah, exactly. Well, that is our show for, I'm sorry.
Well, I was just gonna say, I also want people to know that it's kind of a fun series to watch. I mean, it's hard to talk about Bernie Madoff and fun in the same sentence, but it's fun in that they reenact some of the things that happen. So you see some actors portraying some of these characters. That's kind of entertaining, and it's filmed like it's a a dark kind of a Dateline show, and so you sort of feel like foreboding and ominous things are happening. So I don't want you to think that if you're going to watch it, it's like reading a textbook. It's not. It's watching entertainment. It's just a sad story. That's all.
Yeah.
And the weirdest thing is they taped him. And the weirdest thing is they taped him in jail. I mean, he doesn't look like the pictures of him on his yacht or
and all he's trying to do is say the same thing that we're trying to tell you. He looks straight at the camera and says stuff like notable quotables from Bernie Madoff, or people are stupid, people are greedy, like it's your fault, you idiots, because you actually believed me. It's just like, it's really watchable. I mean, I was glued to it. I thought I think it's required watching for anybody who invests, period, case closed. Even if you just invest in a 401k, it's just worth understanding how things can work and how this went wrong. All right, well, definitely they did a great job. The producers did a great job on this. So I really highly recommend it. And that is our show for today. And again, if you haven't seen it, it's Madoff, the Monster of Wall Street. TV worth watching. And I really do think it's required. All right. Thanks so much for joining us. This is Friends Talk Money, and we will see you next time.
Bye-bye.
Friends Talk Money is funded in part by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education needed by all Americans to make informed investment decisions. Visit investorprotection.org. We also receive support from the North American Securities Administrators Association, known as NASA. It's the oldest international investor protection organization. NASA's members include state and provincial securities regulators from the U.S., Canada, and Mexico who serve on the front lines of investor protection. Recognizing that education and awareness are powerful tools in the fight against investment fraud, NASA is pleased to sponsor Friends Talk Money. Here are 3 important tips to help you protect your money from fraud. With investing, there are always risks, so be cautious of anybody telling you that a certain investment is guaranteed. You should also proceed with caution if somebody is promising very large investment returns. This is a common red flag for investment fraud. Last and most importantly, be sure you're working with a licensed or registered financial professional. You can check your advisor and make sure they're licensed by visiting brokercheck.finra.org. NASA is your partner in keeping you safe and helping you avoid investment frauds. Visit nasa.org and click on the Investor Education tab to learn more.